Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, joined by Fausto Pugliese, President of Cyber Trading U, Michael Normyle, U.S. Economist at Nasdaq, and Chris Dearborn and Brian Joyce, Managing Directors on the Nasdaq Market Intelligence Desk. We're here to discuss earnings, the U.S. economic outlook, and technical trends on the charts. We'll also touch on how to actually trade some of these trends. Gentlemen, it's great to have you with us as always. Welcome back to Trade Talks. And Michael, I want to kick it off with you. It seems as if the Fed's strategy is playing out slowly. We're starting to see mortgage rates come down, inflation come under control. The equity market's starting to digest it relatively well, as we've seen in November. What are your overall thoughts here?
Well, I think, this week has been a little bit quiet for data, but last week we saw some softer numbers come in after the kind of blowout Q3 GDP number. So the first kind of look at Q4 is a little bit softer, with the PMIs for manufacturing and services both coming in a little bit lower than expected. And so signs of that kind of economic cooling that we've been looking for. And then, of course, the jobs report also coming in a little bit weaker than expected. There was the unemployment rate rising a little bit too, along with wage growth slowing. So a lot of the things that the Fed's been looking for in the data the last few days.
Yeah, and Chris, to Michael's point, it has been a relatively quiet week, coming off of a volatile October, playing out as it historically does, going into that seasonally strong time of year in November, and we've seen stocks take a cue from that, although a little bit more quiet this week, again, late on data.
You've seen 3 months of lower lows, right? Last August, September, October, declines significant across all the major indexes. But since October 30th, you're talking 7 days of higher highs. And today it's kind of a waffling day back and forth. The S&P may end up higher, may end up lower. But regardless, you're looking at, for just 7 days, S&P's up over 5%. The NDX is up almost 7%. The Dow's up 3%. Russell's up 5%. I mean, everyone's firing on all cylinders. And more importantly, if you look at the S&P 500 Consumer Index, which is really on the discretionary side, which is where we're looking for to retail spend coming forward. It's going to help this economy move a little bit, since 2/3 of GDP is based on consumer spend. That's up well over 7%. You're looking at the market reacting very, very well. And seasonally, November is always very strong. You go back, over 4 or 5 decades, it's up like 1.9% historically, and usually begins that run from November to April of higher returns across the board as well. So you're looking at a good runway here. Albeit the economic data is kind of starting to play out what the Fed wants, but the non-farm payroll number was, soft, which was what the market needed, I'd say, don't you think?
I agree.
And the Goldilocks expectation here is that softer numbers are starting to play out across the board. You're starting to see unemployment rise a little bit, which is good. Wages start to decline a little bit, as you said. The question is, who's going to be footing this bill? You look at the broader aspect of items. Household debt is peaking again, right? You got over $1 trillion in credit card spend again. So where is this spend going to come from? Savings are dwindling, right? Earnings are starting to not be as robust. How are people going to pay for everything?
Right.
We've talked about that before, and it doesn't leave many alternatives.
Which is interesting. Fausto, you and I have covered this as well, that betting against the consumer has been a really tough bet. And to your point, I understand we're at $1 trillion in debt. Student loans are coming on. We know it's super expensive to take on any sort of auto debt, housing debt. However, if you have unemployment 3.8%, 3.9%, everyone's getting paid for the most part if you want to work.
Everyone's getting paid to work to stay home, and that's what's happening. But I'll tell you, one thing I noticed, though, watching a lot of stocks as trading over the course of the last week, it's big earnings week, the past 2 weeks. A lot of companies beat earnings. I think it was almost 80% of them, they said. So listen, as things I always like to point out is that corporations are going to find a way. What do they do? They just raise prices. So, but the long-term effect, what you mentioned earlier, it's going to affect people down the road. Eventually, they can't keep raising and raising and raising. You got credit card debt that's off the roof. Homes are very expensive. You saw what happened. I live here on Long Island, so you can see how expensive it is to live down there. The people are moving out. So we'll see what's going to happen going into 2024. But I don't know. Over the years, I seeing what's been trading for over 30 years in the market. Nasdaq always finds a way to keep going high, breaking higher highs. We had that big dip after what happened with COVID, but even though we've been down since August, like you just mentioned, we're breaking higher highs. So I'm kind of a little bit more on the bullish side more than more on the bearish side.
It's interesting what you bring up with earnings, and I know you and Phil track the earnings data really closely. I feel like earnings season is almost playing out as it should. If you beat, okay. If you guide, even better, then you get rewarded. If you beat, that's one thing. If you're not guiding well, you are not. You're getting crushing your stock, for lack of a better term. And is that the kind of the trend that you've noticed as well this season?
I think that's what we have been seeing, because the companies that have been beating, they haven't been particularly rewarded for it. But for companies that have been missing, they've been seeing a bigger sell-off than usual. So I think that is playing out like you're saying. One thing that I would say is important context for if this can continue with the consumer debt. If you look at it as a percentage of disposable income, because people have been getting wage increases for the last few years, it's actually close to where it was pre-pandemic. So it's not that stretched, especially if you look at compared to like the financial crisis time. So that is some important context, because of course $1 trillion is a big number,
right.
But when you put it in the context of wage growth, it helps put it a little bit more in perspective.
And it's a great point that you make. And again, if we stay sub 4%, even sub 5% on unemployment, if you want to work, you're working. So at least there is some sort of a stream in income there. I would also argue that the move that we've seen to the upside is also predicated on rates coming down a bit. I mean, the action in the 10-year has been, the rate of velocity in terms of how it's moving has been something I've taken notice of, and so the equity markets have as well.
At 4.5%, it's definitely a nice little bit of a reprieve. But you're still inverted on the curve, right? And you've been inverted for a substantially long time. We're not close to normalcy here, right? It's manufactured to a point, and you go to inflation, it's transitory. It's not. And that's a whole nother conversation. But when are we going to get back to normal? And the U.S. economy is kind of shrugging it off based on the consumer spend. And Mike, it's a good point when you put it into context, but it's still a shocking number, regardless, right? At 1.5 jobs per every person who's unemployed right now, and with higher minimum wages, which is something that doesn't get talked about a lot. The income that people are bringing in can get spent and absorbed quickly, but to Fausto's point, things do cost a lot more across the board. Also living on Long Island, I know that very, very well. And where is it finally going to normalize to? We're back to buying companies for their future earnings growth, as opposed to what they've done in the past, and like you're talking about earnings, hurting them on a misprint, right? You're looking at over 85% of reported so far this year for this quarter, and they've all beat on EPS above the mean estimate on the 5 and 10-year averages, 77% and 74%, right? Yeah. So companies are doing okay. A lot better than expected. I mean, it's well above what we're expecting at the beginning of the quarter, right? There's no doubt there. I just don't know. Everything's with a shaky hand, right? Every time you press that buy button, it's with a shaky hand. Yeah. Because you just don't know.
All right, well, let's bring in Brian Joyce, our Managing Director in Nasdaq's Market Intelligence Desk, as well as our Chief, let's call him technical analyst on our desk as well. We're going to take a look at the S&P as well as the 10-year to confirm the fundamental talking points that we have been discussing and what the charts are confirming for us.
Hey, Jill, thanks for having me. So yeah, as one of you guys noted earlier, we had 7 straight days of gains here in the index, and today we're about unchanged. We've run into this price gap. This price gap goes back to the day after the September FOMC, where we gapped lower. We revisited that level on a brief relief rally in mid-October, where it stalled out after 4 or 5 trading sessions trying to push above that. But it proved to be firm resistance then. Wouldn't surprise me now after the run we've seen for this to act as resistance temporarily. We have seen the small caps pull back the last 2.5 sessions now, and they've already filled that price gap from Friday. As you can see here, this is a 30-minute period chart of the Russell 2000. So I wouldn't be surprised if in the very near term, as we're waiting for the S&P 500 and maybe more data to come out, that it might be more impactful. Next week we have CPI, PPI, retail sales. Maybe from now until then, we see some profit taking by some shorter-term investors and maybe some buyers that maybe are looking for a pullback.
All right, and Brian, of course, let's take a look at the 10-year. We've seen equities react off of that, again, coming in from just about 5% down to 4.5%. That's a big move when you think about the rate environment.
Sure. So, we've come down about 54 basis points from the high 2 weeks ago, 502, to last week's low of 4.48%. Really, the level I'm looking at is right around the 4.5 level. It was a low back in October where we bounced from, and then it was last week's low, just a couple of bips below it. And so I think this is a short-term support level. We've already dipped below today the 50-day moving average, which the last 3 trading sessions was a support line. We've also breaking below today for the first time this rising trend line that's really been in place since early May, when this strong uptrend in rates, started. We were down in early May at 3.29%. So we rallied about 170 basis points over a 5 to 6 month period of time. And so the pullback relative to that uptrend is still relatively, I don't want to call it modest, but I could certainly see it going further. If you look at a little bit longer term on this longer term weekly period chart, I think you could revisit 4.34, and if that doesn't hold, you could potentially get down to 409, 410, which is pretty close to where the 200-day moving average is.
Yeah, and finally, let's take a look at the small caps. They really haven't participated in much of any of the recent rallies, and we're starting to see it broaden out a bit here.
Yeah, so this is the weekly period chart. You can see last week we had the 7.6% rally, which was off of the lows. It'd been in place since June of last year. One of the strongest weekly gains this index has ever seen. It was top 16 of all time, going back to 1978. Historically, that's boded well for future performance. Obviously, the cycle is very different, so this time might be different as well going forward. We're pulling back this week, as you can see. I'm focused on the gap from Friday, which we've already filled. And the next gap down below would be the gap from Thursday, which is down at 165.5 to 167.30 for the ETF for the Russell 2000. That's the IWM.
All right, Brian, appreciate the technical insight as always. That's Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk. And I want to bring it back to our panelist over here. We are finally seeing that small cap participation. And I think that's been another catalyst in this market where we're just not relying on the Magnificent Seven to move the needle here.
Mm-hmm. Well, like I said, I'm a big fan of the small caps. I feel like, as a trader, when you always look at small caps, like when people go out there and trade, it's more about just making the day's pay. So you don't have to deal with some expensive stocks. And like I said, what's happening this past 2 weeks, with all these earnings that came out, I mean, some of the stocks that we've been watching, and like I have a few of them, like Roku, and you've seen like DraftKings, they have been breaking out. But it all starts where the buyers are out there. It's all about seeing where the future is. And when you look at the Nasdaq Book Viewer and we start looking around and see how the Nasdaq has been doing well over the past, I don't know, we have 10 years
here.
here.
We can pull up that chart here too, another technical look relative to what Brian was looking at. So we'll take a look at this long-term chart as well.
Yeah, if you look at that, the Nasdaq index, it's been doing phenomenal in the past 10 years. The only issue that I'm seeing is like, we got to break this 16,000. If we break that 16,000, I mean, you could see a big bull market that's going on. But it's all about seeing these buyers. And I mentioned about those earnings announcements. One thing I was always taught, being a trader, is a company was always going out of business every 3 months. That's why they come out with earnings every 3 months. So.
Well, let's take a look at some of the trends here. I want to kick it off and look at Roku because we have our fundamental discussions, our technical discussions, but I want to review what traders are trading in real time and how you can determine your price levels, whether you're looking at an entry or an exit on these stocks. Well,
like Roku, for example. I mean, they had their earnings this week, and then what ends up happening is that when you look at a stock like Roku, people, and this goes with every stock, they want to know exactly how to view the future. All those orders still out there, because to be a good, what I'd like to do is day trade. To be a good day trader, a good swing trader or investor, you need to see what happens over the course of the day. And when you look at this stock, when you look at Roku, it's all about finding where the support levels are. But what makes a support level? Support level does not exist unless you have those buyers out there that were in the past. And when you look at it and you look at the Roku, you'll notice that there was a huge buyer of 140,000 shares and what made over 340 orders at the price at $81. So, I mean, a lot of people are like, did I miss the trend? Did the stock take off? Is it too late? Well, the point is, are the same orders out there, Jill? And sure enough, when you look at it and you see the stock at 83 and you're seeing 140,000 shares sitting there where everyone else at every other price level is only looking to buy 100, 300, 500, you got to take it seriously. And like I always tell everyone, people always think, is that a real order? Well, Nasdaq won't let you put a real order out there if it wasn't. And sure enough, as you look at it, stock was hovering there, 11:30, hit that support level, just broke out, came back down after 12:30, tested it again, never wanted to break it, and then you go from 81 all the way to 83 over the course of the day. And that's how you really kind of find, and what traders have to look at how valuable some tools are, like using the Nasdaq Book Viewer, to know where those future orders are. So if you think you have support levels, well, to have that support level, you should be out there in the future.
All right. So Michael and Chris, I want to give you the last couple of words here. And Michael, when you think about, maybe 6, 7, 8 weeks out to the end of the year, from a macro perspective, where do you think investors are going to be focused?
I think the same story as it's been all year, really, which is what's the Fed going to do? Essentially, markets are more or less convinced that we're done with the rate hike cycle, and at some point it's going to start transitioning to when is the first cut happening. So I think it's, we had a lot of Fed speak going on yesterday and today, and I think even some more tomorrow, and it's Fed trying to push back a little bit about the excitement in the market. And so I think it's, if the data supports the rate hikes being done, and if it will support rate cuts sooner or later than people are expecting.
All right. And Chris, largely out of earnings for the most part.
Largely, but to Michael's point, which I thought was curious, if you look at the Fed fund futures, right? Last week it was a 60% chance of a cut in the second quarter of next year. That's jumped to 75%, and not just on a quarter basis, but almost a 10% of a half basis point. So that's kind of interesting. That might be interesting for the nominal rate as well, and the cost of capital, which is kind of what everyone's looking at, which goes to the small cap names, especially, right? Raising capital is a huge item here, and higher that nominal rate is, and the longer that nominal rate stays above 5%, the harder it's going to be that they're going to have, and the longer road they're going to have. So that would not only be good for the consumer, for future earnings across the board, but for all caps of stocks, especially the small and the mid-cap names.
All right, gentlemen, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.